Hello, welcome back. In this video we are taking a look at Oracle Corp. It is a company that has been absolutely bust in the stock market, about 40% down in the last year, but right now it's up 11.6% after it had its earnings report pretty much. And you will see that after Oracle's strong earnings beat, Wall Street remains cautious on the stock. We're going to examine, of course, what happened here. So let's take a look at the earnings report first. And so as you'll see here, Oracle is up 10% on Q4 results. Prospects for Oracle continue to look better. Now here's what happened. Net income at 3.2 billion versus the year ago figure of 4 billion. So this is actually worse here. Per share earnings of 1.16 below 1.37 in Q4. And on an adjusted basis, EPS at 1.54. Revenue up 5% year over year to 11.8 billion. And the consensus was for 1.37 of adjusted EPS on 11.8 billion in revenue. Now, as you'll see here, they said that they experienced a major increase in demand in their infrastructure cloud business, and they believe that this revenue growth spike indicates that infrastructure business has entered the hyper growth phase. They also announced 32 cents per share of a quarterly cash dividend on Monday. Interesting to see as well. The real story here is the impressive 39% growth in cloud infrastructure business, putting Oracle's growth more on pace with the market leaders here. So this is probably what prompted the stock to go higher right now, because some of these numbers have been suppressed. But again, we were kind of expecting this kind of decline, and so when you're having low expectations, you can get still a pretty steep increase in the price of the stock if things are a little bit better than expected again. So let's go back and examine what the company is doing financially now. If we go back to our stock analysis tool here, we can kind of see whether it makes any sense to buy this stock right now. And it is a $180 almost billion market cap company. You will see that their PE ratio is sitting at 24 over here, and it has been climbing slightly, but overall it's going down from what it used to be some years ago. Price to free cash flow ratio at 35.6, may be a little bit elevated here, but the company has been buying back shares like crazy over here, so you will see that the outstanding shares has been decreasing overall, about 26.6% in the last 5 years. So the company has been buying a lot of shares back, and this is amazing to see, of course. Now they do have quite some liabilities compared to the free cash flow, but that has a lot to do with the extra debt that the company has been getting, and we will see that in detail. And the same thing happens with the free cash flow growth and the total equity growth here. Now the free cash flow growth has been going down here because of some extra capital expenditures. This is probably not a big deal. And the total equity growth has been going down because the company has been getting too much debt. Presumably to actually using debt to actually buy some shares as well, buy back some shares, because they have bought an insane amount of outstanding shares here. But the fact remains that they have been recently having negative equity. Now you will see here that the net income margin of the company is sitting at 15%. The returns are currently negative because again equity is negative right now. And the dividend yield of the company is 1.99, so basically 2%, with a free cash flow payout ratio which is a little bit scary here. It's sitting at 68% in terms of its free cash flow. So this is a little bit elevated, but remember that this is the last year's free cash flow, and the company had elevated capital expenditures, so this won't be the same in the years to come, because again they spent more. So this is probably much lower here, practically speaking. Now if we take a little bit of a look at the dividends here, which have also been increased. They increased them to 32 cents is what they said. Actually, it's the same. They actually announced the same pretty much. They didn't increase it, so it's going to be the same. And the company has been increasing dividends nicely over here. Now, the effective yield is 2%, yes, and basically about the same with the last 12-month one. So very interesting to see. It looks like the company doesn't have too much trouble paying back the dividend. And we will examine why, because we need to see at the financials, we need to check on the financials to see exactly what is going on there. But overall, you will see that the company's financials are looking pretty solid here. And you may be having a little bit, of course, of a concern in terms of its free cash flow and total equity. But we will examine that in our financial statements, because there's a story behind that. Now, 39 billion to 42, not a steep increase, of course, very little increase in terms of revenue growth here. We'd like to see more, obviously. And net income that has been increasing. So while the revenue hasn't been increasing much in the previous years, it has been increased. The company has been increasing their net income, which is an encouraging thing to see, of course. 3.8 to 6.7 here. So they're increasing profitability, becoming more efficient, presumably. with their operations. But you will see here that the total equity is getting in negative territory, so from 22 billion to minus 5 billion here, and the total liabilities of the company have been increasing a lot, as you will see here, and that's because of the company has been buying a lot of common stock back. Now, if we take a little bit of a look at what is going on with the cash flow statement here, you will see that the net income of the company has been a little bit worse in fiscal year 2022, which is basically happening right now, and it's actually worse than the previous year, and it seems like the company is not generating that much profit when comparing to the previous year, so it looks like they are doing a little bit worse right now. Now, if we go back here, I kind of want to examine what contributed in this kind of decline in terms of the net income. And you can come over here and see that while the revenue increased and gross profit increased as well, you will see that there's a little bit of more in terms of selling and marketing expenses and a little bit more in general and admin expenses, but this doesn't really explain the decline in net income. What does explain it for the most part is the increase in other expenses, which is more than likely a one-off item here. It's more than likely something that's not going to happen next year, but it's worth noting what actually contributed to this one. And so the total operating expenses of the company have increased about 10 billion. And this is why you're looking at a negative number, actually a negative growth here. This would normally be at around maybe 16 to 15 billion here if they haven't actually added this other expense here. You can of course take a little bit of a closer look at what kind of expense that is, but this is probably a one-off item that's not going to be happening next year. So it's useful to know what is going on in terms of the net income of the company and why the cash flow has been affected here, and this is why we're starting with a much less net income and actually getting less cash provided by operating activities, and of course this is going to affect our free cash flow here. Now you will see the decline here, but again this doesn't necessarily mean that this is problematic. It may be a one-off expense, and it does look like that's the case here. Again, you can examine that more in detail if you take a look at the actual report that the company had, but it really does look like it's a one-off expense here. Okay, and remember that you can, generally speaking, discover these items filed as unusual items pretty much, because again they are one-off expenses if you want to take a look at the report. And so, if we take a look here at the cash from investing activities, you will see that it's now very, very positive here, because the company has sold quite a lot of investments without purchasing too many new ones, it looks like over here, and they have increased their capital expenditures a little bit as well. Now paying some dividends as well, that's a hefty number here, 3.4 billion of course, and this means that their financing activities is in the negative. They have been purchasing common stock, look at this one, insane repurchases of common stock here, which is why they have increased part of their debt as well. They still have quite a lot of cash though, and they seem to be doing pretty well in terms of free cash flow. Again, don't pay too much attention to this one. This happened because of the one-off expense. Now, if we take a look at the cash flow, the stock evaluation too. Now, we do know that the company has had a declining revenue pretty much in the last few years. It is only 2022 which actually increased about 5% here. So you will see that the 5-year average has been 1%, 4.8 has been last year. Now we did examine their earnings report, and they said that their cloud infrastructure gains are actually improving, and so this may be a little bit better in terms of revenue growth, but I'm still going to go relatively conservative. I'm going to go 1, 2, and 3. This is obviously a behemoth here, we want to be conservative. The net income margins have been overall pretty similar here, which is something that you like to see. I'm gonna go somewhere near 15, I'm gonna go with a low one, 19 maybe, and 23 here, because there has been a little bit of a variance. So overall it seems like it's more than 20, but let's try this and see what we're getting. And the free cash flow margins have been near 100 here. I'm gonna go 90, 100, and 110 because the company seems to be achieving that. So annual return of 13%. Let's see what we're getting here if we hit calculate. Now, yeah, we're a little bit far from what we'd want it to be. Our net income margins here may be a little bit suppressed. We could do 22, 24, and 26 potentially. This is a little bit more aggressive, of course, as you can understand. Oops, that's too much here. 24. And this means that we're actually within our limits for our high estimates, and not too much within our limits because remember, this company is going up today about 10%, so this is probably going to be red as well. So why I like this company looking good. If it drops a little bit more, I would much rather buy it. If it drops, like it's gonna be 71 when the market opens, And right now it is a little bit expensive for my needs really and for my portfolio, so I would probably avoid till it potentially drops significantly. Maybe near these levels here, I don't know, it's like 60, probably even more. Yeah, I probably want to get it near 50, something of that sort, maybe around this range would make more sense for me. So thank you for watching this video. Let me know what you think about Oracle, whether you own it. It's not a terrible company, of course, to own. It's not extremely expensive, but it is relatively expensive compared to what you can find around. If you shop around these days, there are many opportunities. This one is still a little bit expensive, but again, yeah, not terrible for sure. But thank you for watching this video. Remember to leave a like and subscribe, and also remember that you can become a Patreon and gain access to this tool, full unlimited access, and you can find links in the description box below this video. Thank you for watching, guys, and I'll see you soon. Bye bye.